Good evening, ladies and gentlemen, and welcome to our class on trend trading. Now, tonight's class is sponsored by TradeTime, one of the world's leading Forex and CFD providers, with a very unique offering. They allow you to customize and personalize your own trading approach and your accounts. You can define your objectives. You can customize your account and your dashboard, as well as trade in the largest markets. But what this means to you is you can set your own level, your own personality. And what will happen is your platform will fit your personality, but so will the market alerts, the emails. You know, like if you're a commodity trader, you're not interested in cryptocurrency, they'll make sure that what you're getting in the news and flashes and updates on your screen are only about things you're interested. If you're a shark and you're looking for high risk, high profitable trades, their signals will be customized to fit your type of environment. If you're a guy who's looking for low risk and higher probability success rates, those are the type of signals you get. And you can change it all you want. The whole thing is about letting you set up the platform any way you want. So you can select from a broad range of options to build your own personal trading account. You also get a huge array of trading tools, and you can decide what you want. You can take them all or just block some, set them up, decide what is interesting to you. Now, because TradeTime is a regulated provider, all your funds are held in a segregated account and secured with leading industry encryption. You get their proprietary TradeTime platform, which is very unique in the market. As you can see, it's very easy to look at. Their information is laid out in a dynamic view that is all designed in a user-friendly environment. And their new TradeTime platform is intuitive and user-friendly. You can customize the alerts you need. You can do one-click trading if you like, and you can download whatever advanced charts and indicators that you prefer. As I said earlier, the signals can be fully customized, and you can see the first objective, the second objective, where to put your stop loss, and you can see also how many other traders have actually initiated or executed trades based on that signal in the last minute. Okay. So you can see how many other traders have found that signal valuable. So remember, unleash the trader in you. Be personalized, be customized. So if you want, while we're in class, you can go to www.tradetime.com and open a demo account. You can fully customize your demo account also and see how all of this reflects your personality. And you can start trading on their next generation platform. Now, tonight's class is being recorded. If you'd like to see a recorded version of tonight's class, give us about 24 hours after the class is finished, and you can go to investing.com, you know, where you signed up for the webinar, www.investing.com, and locate the education tab and to go look for webinars on demand and find tonight's class. So let's get started talking about trading the trends. Now, trend trading is a strategy. It's not about trend lines and building trend lines. It's a whole strategy for trading in the markets, for following the trends. And in order to do this, you have to be very knowledgeable and comfortable with understanding how a trend moves, not a trend line, but a trend. So trend following is perhaps the most popular long-term strategy in the financial markets. As a trading strategy, it is exceedingly effective and profitable when conditions are favorable. And it's quite straightforward in its methodology. And there are many individuals, past and present, famous and obscure, who have used this strategy to success and riches. We should note that the technical aspects of trend following is in fact quite simple, but also requires that before everything else, you have discipline, sound money management, and patience. Trend following is not about short-term method, and patience and determination are as important as correct analysis as a result. Now, remember, trends are created by powerful underlying economic factors, which may not be all that clear to those who are not familiar with fundamental analysis. But the simple patterns created by the price action in response to the economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader has as much potential of success as the most experienced analyst if he can control his emotions and behave logically. Now, this is not saying that you have to follow a fundamental analysis, not that you're reading the economics, because you're not responding to the knee-jerk reactions in an asset just because the jobs report came in better or worse. What you're actually looking for is a trend in the marketplace that is slowly developing and developing properly. So identifying market trends based on the natural occurring of swing points in the market. Higher highs and higher lows define an uptrending market, while lower lows and lower highs and lower lows define a downtrending market. Now, to apply this strategy, we must first be aware of the existence of a trend. So what you're looking for in this case with trend trading is you're not looking for particular events. You're not looking for RSI or stochastics to kick out an alert. You're not looking for a speech from Trump. You're not looking for jobs data to be better than expected. And you're not looking for Mario Draghi from the ECB to be saying anything. What you're doing is going through the assets you like to trade and looking for a very specific trend development in the marketplace. So without identifying a trend, we would just be gambling. And that's not the purpose of trading Forex. Both fundamental and technical analysis can be employed for identifying a trend, and both of them have their advantages and drawbacks. It is in general a good idea to use a combination of them for deciding on your trend's character and deciding on entry and exit points. Now, you do need the help of at least support and resistance levels to figure entry and exit points. But we want to observe the marketplace, and swing points is the first point of call in determining if a market is trending. So if you do not see a pattern of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend, but instead you see sideways price movement, it's not obviously a general up or down direction. Then you're probably looking at a range-bound market and one that is simply chopping back and forth. The more well-developed you find a trend, okay, and the stronger that trend is, the more likely you're going to hit on a winner. Now, in order to first look for this, we have to know what to look for. So we're not looking for a market that is just moving up or down. Now, you have to remember, when we talk about lower lows and lower highs, and swing lows and swing highs, we're talking about the peaks and the troughs, or the peaks and the valleys, or what I call the push and ease. An asset moving properly in a trend will push, whether it's a downtrend or uptrend, and then ease. Push and ease, push and ease. When you see this well-developed pattern, and each pattern makes, in a downtrend, makes lower lows, you now know you're onto something. And this is just the 30-minute chart of the euro US dollar. But we're looking for this well-developed trend. This trend that we see here in this uptrend wasn't a well-developed trend. It was just something pushing the price up. Okay, and it wouldn't have given us something that was really tradable. Okay. Now, other ways you could have traded this, but not for trend trading, because you have to believe and fully understand that markets move in trends, and that these trends will have these pushes and eases. They'll have their peaks and valleys. Okay. When we can see the market making these peaks and valleys properly, we then can start predicting the future of peaks and valleys. Let's go back to my PowerPoint. Let me get these markings off of here. So what we want to look for are either highs or lows. You shouldn't have to think too hard about whether a market is trending or not. Most traders make trend discovery way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending or not, just by looking at the raw price action on its charts from left to right. Make sure you mark the swing points on your chart, as it will draw your attention to them and help you see if a pattern of higher highs and higher lows or lower highs and lower lows, as we discussed. Now, let's go back to this Euro US dollar for a minute, because I find I don't like to use a candlestick chart when I'm looking for the pattern. I much prefer a good old-fashioned bar chart, because then I can see price without seeing the reds and greens, and I can actually see these peaks and thrusts without having to deal with bodies of candles. Okay, and it helps you notice the market trend better. Okay, you can also start out with a simple line chart, because a simple line chart is not going to help you make a decision, but you'll see that the market is moving down. So we see you have a steady downtrend, but nothing well developed that we can actually trade it. Then we put it in the bar chart, and we can see these pushes and eases without getting involved in the colors of the candlestick. But you can use candlesticks also. As we started out, we were using candles to begin with. It's just sometimes the red and green just distracts you from seeing what is happening. So we can also see now look at Bitcoin price. Now this is Bitcoin in dollar, and this is from my previous class, but I just had it up on the screen. Now we can see Bitcoin has been steadily trading in an uptrend here, but it's not a well-developed trend that we could have seen the pushes and eases. It's been a steady up moving. So yes, you might have used other ways to trade, but not trend trading. Okay, because trend trading is all about finding the proper trend, trading with the peaks and the valleys. Now, if we're looking at Bitcoin just a little while ago, we look at this. We would have seen this push, ease, push, ease. But then it didn't get a well-developed trend. It made a higher high, but not very strong high, and push and ease, push and ease. Now we've got a weak trend. It is not a well-developed trend. So would we want to gamble our money away, or would we want to wait for a better trading opportunity in a different asset? So these are questions you want to ask yourself, but it's spotting these proper trends. Now, you must first choose whether you want to employ technical or fundamental analysis for your method, or any combination of both, because things like moving averages will help you spot a trend. Okay? There are many different ways that you can do this. Fundamental analysis can provide you with information which can predict the strength and length of a trend, while technical analysis can show you how it develops. It is possible to base your strategy on one of these to the exclusion of the other, and it's still possible to turn a profit if you are lucky enough, but our principle has always been to reduce the role of luck to as little as possible. Fundamental analysis is more reliable than technical analysis in defining a trend that has a long-term potential, but without technical analysis, it would be extremely difficult to decide when and how to trade. So, in other words, if you're seeing a lot of fundamental analysis or fundamental events for the Eurozone in a positive light, and you're seeing positive cues from the ECB, what do you think will be the positive trend for the euro? The euro should be climbing up. Now, let's forget that the dollar is climbing down, but the euro should be climbing up pretty steadily, and that's what's happening. We saw the euro bottom out around 108 a couple months ago. Now it's steadily trading, and I think it was at 123 on the charts. Well, this is because the Eurozone is going through a very slow, but now very positive recovery. The ECB is cutting back its tapering. They're starting to mention inflation increases. So everything is moving in a positive direction. Because remember, trend trading is not short term. You can use it for day trading, but it becomes a little bit more difficult. Now, technical analysis, on the other hand, it's got a very difficult time, can suggest that a trend is beginning, but it's got a very difficult time in helping you more than seeing the trend, okay, and predicting long term. But technical analysis will help you spot the entry point and exit point. And a simple use of support and resistance and a trend line along with volume can give you excellent entry and exit points to a trend. Now, there are many technical tools that can signal the phenomena, but there are an equal number of false signals generated by them. Remember that there are only three kinds of trends that exist at any time: flat, up, or down. And it is possible to speak of trends between any 2 points on a price chart. Simply take two random points on a chart, draw a moving average on it, and the pattern that arises can be analyzed as a trend. Thus, it is always necessary to have at least a basic understanding of the economic factors that can create trends before deciding on the validity of the chart pattern. Now, remember, there's a difference between trend lines and trends. Trend lines have various firm rules about how you draw them, but they don't tell you well-developed trends. Okay. Trends are different because they can break a lot of the rules that a trend line can't. So if you see price moving up and down and it falls below what you would consider a trend line, that doesn't mean the trend is over. It does mean your trend line has ended. So what kind of price pattern will create a trend? The trend that we seek to trade is different from random fluctuations, range patterns, and similar price movements in that itself, in the absence of any technical indicator, can still be recognized as showing a trend. In other words, there is some driving conviction behind the price action, which allows the trader to easily identify it visually. Depending on the type of trend, that's up or down, successive highs or lows should constitute a rising or falling pattern with relatively few irregularities. But such a case is often a rarity, and the trader will have to back his technical patterns with conviction that can perhaps only be gained through fundamental analysis. I find the easiest way to do this is just take the group of assets that I trade, and when I see a very well-developed trend exposing itself, I then go and start trend trading. If I don't see a well-developed trend, I don't go searching elsewhere for them. You can, because this is all about finding the right trend and less about finding the right asset. So you might see, okay, the Eurozone's recovering. Let me see if there's developing a nice trend against the yen, against the pound, against the dollar, and see what is happening somewhere. But we have to see that developed trend. So if the trend can be identified visually, why use technical tools? So even though we can notice the existence of a trend, we still need technical tools to trade it and time it. So trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retrace before the next leg in the direction of the trend. You will notice this pattern happens in almost any trend you can find. The retrace is the push and the ease, the push and the ease, the push and the ease. Typically, what happens is too many traders is that they will make some money during the periods of strong directional trend movement, but then they continue to trade as the market takes a breather from that trend and consolidates. In these periods, when traders give up all the gains they just made when the market was moving aggressively. You need to learn to identify the different parts of a trend that this will help you avoid over trading during choppy or consolidated periods and will give you a better chance of making profit when a strong move comes. So here's an example of what I was talking about. So you can see, look at this beautifully well-developed trend. Push, ease, push, ease, push, ease, push, ease, push. And you can see, and as you can see, you can't draw, you could actually draw some of these arrows on a trend line, but you can see the steady movement of price moving up and the shallow retraces, or the retraces and the consolidations, and watch them move in a well-defined direction. So we can see that a trending market tends to move in spurts, moving in the direction of the trend and then stalling to take a breath before another leg. Now, if you understand these, you will not panic. Now, just start to think, when price is moving up steadily, you have buyers who enter the market. The buyers buy, the market moves up. So then a new row of buyers buy, and they keep pushing the market up, new row of buyers. Well, at some point, the buyers are bought out, or the buyers are saying, you know what, the price is too high for me to enter. So they'll wait for the market to retrace, and at some given point, they say, okay, I'm ready to enter. Or the buyers that get tired out early are ready to enter, and then they push the market back. And this is what you need to see. Okay. Now, when we can combine these with support and resistance levels, okay, on our charts, we can then help identify where these lower lows or lower highs should take place. And they should bounce off of support and resistance levels, Fibonacci levels, okay, pivot points. All of these will help you figure out where these retracements should occur. Now, these retraces are when we have the highest potential of a high probability entry within a trend. Often a market will retrace to approximately the levels of its previous swing point before the trend resumes. In an uptrend, these swing points are support, and in a downtrend, they are resistance. Look at the very first diagram for a quick refresher on what I'm talking about. So let's look at the charts we just looked at, but this time with the support and levels marked. And these support levels resulted after the markets began to retrace lower within the structure of the broader range. So as we can see here, we've brought our support levels forward. Our support levels in this case were done by what we call eyeballing, looking at the previous swing highs, where the price consolidated or reversed in the previous. So the market will typically retrace back to the previous swing point area, then bounce higher, resuming the uptrend. These are points where we want to look for price action setups. So when price moves up through the support level and then bounces off of, what we look for is when it would touch the previous support level and bounce up. This gives us our price action setup. Same thing here. It hits the resistance level, calls back to support level, gives us our price action setup. Again here, each retrace as the trend is working exactly as the trend should be. And as you notice, this is not very complicated. Okay. It is the most complicated part is finding the asset that is trending. Okay. Market timing never works when one is trying to predict reversals on a technical basis. Okay. However, market timing in the context of a trend with the purpose of picking the counter trend extremes and using them to enter a trade is necessary and profitable. And there lies the main principle of trend following strategy. Recognize the trend, identify the counter trend moves, and use them to enter a trade in the direction of the trend. Okay. Now, the question is, how do you time your trade with technical analysis? The best trading tools for trend following are supplied by moving averages and simple price charts. Bar charts, candlesticks, and many others can be equally useful if employed with moving averages. It is also possible to use moving average crossovers like MACD. and a myriad of other methods. But whichever you choose, you should ensure that you do not complicate the main aspect of your strategy, which is following the trend. If you do not want to trade on a weekly or daily basis, a 100-day moving average will probably be able to capture most of the important trends for you. Or if you're trading in CFDs and you're trading in Forex, a 10 period and 20 period, or 10, 30, 10, 20, and 30, or a 30, 60, 90 moving average crossovers can do the same thing for you. Anything with a longer period is likely to be meaningless because too much data is discarded. Okay. So as you can see here on this chart, you can see a beautiful trend developed. You can see each entry and exit point. Okay. And we can see how the moving averages crossed over, and at each point of those crossovers, we could have entered a trade using that also in conjunction with our push and our ease, our push and our ease, our push and our ease, because our longer and shorter moving averages cross over during the points of pushes and eases. By adding that together with a simple RSI oscillator below, we get a third support level. So we have support and resistance levels on our chart. We've got simple moving average crossovers. We have a beautiful trend, push, ease, push, ease, push, ease, push, ease. And all we're doing is trading at the moving average crossover and watching them to be confirmed with our RSI either over 70 or below 30, telling us our markets are overbought and oversold. And we've got a beautiful trend trading strategy. Nothing difficult, nothing complicated. Now, it's testing it and making it turn into action so that you know how to be successful. And that's what we have demo accounts for. And on Trade Time, you can set up this demo account, set up all of these things on the charts, and then watch them develop and make demo trades and test it out and back test it till you have the strategy down pat. Now, it's also important to put the proper stop losses and take profit orders. This partly depends on the term and nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it is provided by the moving average or a simple line drawn on the chart. In our opinion, the trend follower should not realize his profits until he has a good reason to do so. The purpose of the strategy is to focus on underlying price dynamics by stripping out volatility and short-term movements, and there is a little logic to realizing profits in response to fluctuations, which are irrelevant to the main action of the trend. This trading method involves a risk management component that uses three elements: number of shares or contracts, the current market price, and the current market volatility. So you have to make sure that you use proper money management, because you don't want a highly volatile market, but you need to be protected if that retracement becomes a reversal. You want to set entry points, and you should always tie this directly to price. And always money management. Another decisive factor of trend following is not the timing of the trade or the indicator, but rather the decision on how much to trade over the course of the trend. Cut losses as a rule. This means that during periods of high market volatility, the trading size should be reduced, because you don't want to be in a trend trading strategy when the markets get very volatile. So cut your positions or just exit the market. Trend following should be systematic. Price and time are pivotal at all points. The technique is not based on the analysis of fundamental supply and demand factors. So in Forex, bearish and bullish trends are typically equally as violent and potent, whereas in the equity markets, we tend to see slower moving price action in a bull market along with lower volatility. Okay, so remember, in Forex, okay, and commodities, you will see an equal downtrend to an uptrend. So in other words, that's why Fibonacci's work so well, because an asset that falls will tend to retrace a good deal of that fall in its uptrend. So the simple rules presented here are good enough to replicate the performance of many large name trend following hedge funds with high precision correlation. But remember, position size, timing, filters, okay, entry signals will all get you into the market correctly. But there's an old saying that goes, the trend is your friend until it ends. So this one line sums it up pretty well. This one line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such as a short-fire trend continuation setup. Price action can help traders diagnose and trade trends. Indicators like MACD and RSI will also work very well for you. Exit signals are very, very important. Exit on 3 average true range moves or on moving average crossovers. But make sure you have an exit signal or an exit strategy. Remember, trading a trend following system is not a single market, not on a single market or only on a few different markets is suicidal. There may be long periods, even years, where there's simply no trends in any given market or asset class. The key idea is to trade many markets covering all asset classes at the same time. If you fail to do so, the strategy is simply not work. The investment universe you choose will have a much greater impact than tweaking buy and sell rules. So choose wisely. You should choose a broad set of markets and avoid too high a concentration in a single sector. In the long run, a healthy balance between all major market sectors will help you, because what you're looking for, remember, is the properly developed trend and then executing on that trend. After all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movements. But the fact of the matter is that biases do exist, trends do take place, and in many cases, those trends may continue. So make sure you factor in market volatility, but find your strategy, own it, keep it simple, and get it done. Thank you very much for joining us, and thank you for supporting Trade Time. Again, go to Trade Time, open a demo account, and try this out. Look for the assets with trends. Then watch how the trends respond. Look for the retracements. Look for the peaks and the valleys. And then find yourself a simple moving average crossover system, and you can decide how many days. You decide it. Set it up 3 and 6 days, 3 and 9 days, 3 periods and 22 periods. You test it. See which one works for you. Watch when the crossovers happen. Watch when the price action changes. And keep adjusting them until you find your own unique way. Make sure you put support and resistance on your chart. Volume's important. And find one true indicator, whether it's MACD, RSI, or stochastics, that'll help you make your final decision. On that note, thank you very much for joining us and have a great week. Bye now.